Good morning, everyone. I can see there's quite a few people joining, and it's just gone the hour, so I think we'll make a start. So thank you and welcome to our presentation from Charles Taylor Adjusting today on cyber business interruption, trends and intervening events. I'm just going to cover off some quick housekeeping before we get started. So please note that all attendees are muted. We can't hear you. But if you do have any questions or comments throughout, please type them into the questions section of your side panel, and we will address these at the end. The session is being recorded today, and we will send all attendees a follow-up email after the presentation and give you a copy of the recording. Additionally, we would be really grateful for any feedback you may have. So there will be a short questionnaire that pops up at the end of the session. So if you wouldn't mind taking an extra minute of your time for that. To introduce our speakers for today, we have Laetitia Fouquet, who is Global Head of Cyber and leads a program of more than 50 specialist adjusters globally across 6 continents, dealing with complex cyber cases. You'll also be hearing from Terri Adams, Director and Business Interruption Specialist, who primarily deals with business interruption aspects of high-value commercial losses across a wide range of sectors. You can download their full bios in the handout section on your side panel, and you can also find our Charles Taylor Adjusting Cyber Capabilities brochure to download. So I'll hand over to Laetitia now to make a start.
Good morning. So we're going to discuss quite a few things this morning. I'll try to be brief on my side because we really want to concentrate on the business interruptions part, which Terri will discuss. But just to start, we'll look into different trends affecting cyber claims and BI triggers and financial impact at the moment, the impact of working from home and COVID challenges, and also discuss whether we think bigger companies may be more at risk than the SMEs or vice versa. So to start, right, a little bit of history. I'm not sure if all of you know what the picture is on your left-hand side, but effectively this is an Apple computer from 1976. And cyber started really in the 1980s with general liability policies, and with the evolution of technology, policies have also followed. So in the 1990s, quite a few standalone policies were put in place, I think with AIG in 1997, but they were mainly third-party liability to start with. And in terms of the evolution of technology, well, we've gone now into automation, full connectivity between devices, the Internet of Things, etc. So we have to follow that technology evolution anyway in policies. And we've moved from, as I said, third-party data privacy mainly into standalone first-party costs, including IT forensic, legal notification costs, restoration of data, and then business interruption and contingency business interruption. Social engineering and crime endorsements are now much more common. We're also looking into breaking or replacement of equipment and licenses for software, reputational damages and penalties. So it is gone from what was a very kind of restricted type of policy into much broader policies. And what we're seeing as well is much more sector-driven policies as well, with new risks for supply chains or management services, as well as for marine cyber, for example. So very sector-specific policies at the moment. And as we move away from silent cyber and there's new regulations, we still have quite a lot of affirmative covers working at the same time and claims being notified under various policies. And in terms of the threat, we will be discussing that they are more sophisticated and opportunistic, more resourceful, and unfortunately that crime at the moment is still paying. So if we move to the evolution of the triggers, you will be aware of some of these triggers. We're still seeing a little bit of denial of service, but mostly at the moment is malware and ransomware being in the news. some system failures. What we really see associated with business interruption is the business email compromise, although they have obviously some financial implications. And it doesn't really come always from external threats. The system failures are from internal. They can create huge costs just to remediate a problem, and can create increased cost of working as well as loss of revenue. The increase of sophistication has meant that it takes longer to remediate, and that would create a bigger loss for remediation costs, restoration costs, and business interruption, obviously. The more businesses now are reporting attacks, we see an increase in frequency, and the frequency of business interruption being also part of the claims. We've also seen quite a few claimants being hit more than once in the same coverage year, with different attacks actually, and even though they did a very good job at remediating the first time, they were hit a second time. And it doesn't really always mean that the security was inadequate, but there's a lot more tools that the attackers can use. There's obviously more sophisticated and more complex tools they can deploy. But also we see them working a lot more together, buying from each other. For example, UK uses TrickBot and Emotet, and one of the signature of Emotet is to access the systems of the organizations and maintaining a presence in infrastructure, and then they sell that to other threat actors who will then deploy their malware. But we also see this with Dharma when they manage the deployment of the ransomware and the payment system, but the affiliates are responsible for contacting the victims and deploying in the system. So Dharma effectively is only involved at in 30–40% of the attack. But you can see that on average, the ransom payments have increased. We certainly saw that starting at the end of the last quarter of 2019. Unfortunately, it's not stopping, and attacks are, the ransoms are, demands are higher, but we've also seen over the last few weeks actually a lot more attacks taking place. And ransom as a service is a good way of monetizing, but it's a nightmare for us because not everyone has the decryption key when they deploy a ransomware. And effectively, it means also that there's a lot of variants on the market, and it may take just even longer to remediate. So as COVID-19 working from home created any more challenges, there was an expectation that medical facilities or services will be more targeted. But actually, we've seen the targets moving from professional services, education at the start of, or at the end of August and start of September, and a general impact on technology and communications. And what generally working from home has highlighted is the vulnerabilities that were already present on the system, and an issue with companies having to adapt very quickly to the staff working from home, but not always doing their homework in terms of what security they had available before doing that. And we've had quite a few claims regarding unsecured VPNs, remote desktop, and generally very bad policies across the review of user credentials, recycling passwords, using multiple devices with the same password, using personal devices. We've had a claim where actually one of the staff was using his personal laptop to access critical services, and at the same time they were looking at getting copies of videos or films, movies on the internet from illegal sites. So this we think is quite a common issue, and generally people remain the weakest link. 90% of the ransomware attacks will start with social engineering. So if you can eliminate a member of staff clicking on an email that contains some malware, you're already winning effectively. But also some issues with furloughing staff. So in terms of what we have in our staff to support us if we have an attack, if you have the attack, is there enough staff to, before an attack, is there enough staff to actually just monitor and really having maybe to furlough staff to get the appropriate response. And generally an issue with investment, which was already present before the first lockdown, but which we think is going to be a long-term issue because people may have less available funds to invest in better systems and more security at the moment. And what has this created in terms of business interruption? Well, obviously, a delayed detection and dormant attacks are likely to create more costs. We've seen a reduction of dwelling time, but still we think there is a lot of opportunities to lay dormant on the system and deploy it more easily. More panel vendors cost as a result of limited staff or higher increased cost of working. Site access has been an issue, in particular in one case where subsidiary was in China at the beginning of this year, and everything had been locked down. There was no access at all to that site, so no way of remediating or making sure that the remediation had been carried out in another country could also be deployed in China in time. And also trying to ascertain, and Terri will discuss that a bit further, but trying to ascertain what is fully in keeping with what would have happened if this was outside of working from home lockdown and that COVID period compared to normal trends. And what is a normal trend when you were hit in the middle of a lockdown or at the end of a lockdown? That's a challenge in itself. So the impact of the current trends, as I was saying, so a lot more downtime caused by business interruption on an average is about 2 weeks at the moment. Also, we do see some attacks that can take 4 to 6 weeks to remediate fully. Usually you go back to some sort of normality a little bit earlier, but that normality is obviously not 100%, and therefore you will have some business interruption incidents. Increased cost of working has increased generally, as well as remediation costs, just because these attacks are just more sophisticated and take longer to remediate. Having the right assistance is really important. We've seen quite a few issues with the insureds notifying insurers very early on, and then there's complete radio silence for a few weeks, and then they come back and here's the bill. That doesn't really work. Also, it makes it very complicated to see what was done, whether it was reasonable at the time. Did they think about, did they think outside the box as well to mitigate their loss, etc. Much easier to be involved at the start and discuss all of this whilst they're still remediating. And unfortunately, a lot of insured have not really considered what would happen in a worst case scenario. So a lot of the limits can be exhausted quite quickly in the context of an extortion payment plus remediation cost plus BI. So I've put a few statistics here from the Net Diligence 2020 Spotlight on Ransomware, which is available online, but you can see that there's been a net increase. And it's not really looking too good if I'm honest. Are big corporates more at risk than the SME? We've certainly seen a lot of increase of claims in the SME sector at the beginning of the year. They were also hit with more sophisticated ransomware, and I've given you here, some analytics that I found regarding the type of ransomware, and that would be available in the slides that we can circulate. But generally, even ransomware that is in the lower end can be still quite sophisticated for an SME to remediate. For big corporation, restoring data via backups or decryption may take longer than restoring the network of a small business, just because of how complex the network may be. But they will have more manpower or more ownership over the security of their system. So it may work better in their favor. And according to Verizon recent study, the payments have increased to the range of further payouts last year were an average about $41,000 US dollars. They're now more in the hundreds of $1,000 at the moment. The top 2 ransomware variants that we're seeing at the moment are the Sodinokibi and the Rai UK. And on the other end of the spectrum, for the SME, we see more of Dharma, Snatch, and Networker for the SME business. Multiple location may be impacted, which will make a remediation a bit more complex, which creates different types of business interruption as well. And costs, we've seen a lot of issues with big corporates where there's someone at the head trying to coordinate, but then a lot of the local coordination is then left to the business units. You will then have to discuss why there's variations and one unit is doing better than another one, and that creates some more discussions with regards to BI and the cost incurred. Some sectors have been more hit than others. As I was saying earlier, we've seen a lot in the education, professional services, and IT. And the SMEs are now becoming collateral damage. So if an attacker can't get into a big corporate, they may just try and hit one of their supply chain vendors or clients and try to get in through that way. And the tactics generally are changing. They're using more lucrative tactics where they use effectively second extortion. Rai UK recently moved into a new identity, Conti. And they're using the hosting a shaming blog, and as they've been doing that in August 2020, but we'd already seen that with Sodinokibi and with Maze. They were pioneering really the shaming sites, and what you see now is maybe them boasting to that they're working as a cartel. So the tactics are changing definitely. And you could be extorted twice. So you could think that you've not had any data access, and then there's the shaming tactics coming later on. And it can be a delayed effect on that, which would be up to 6 months as far as we've seen. So in terms of reputational harm and BI, are they the same? Well, often the indirect cost of a cyber attack is the harm that's caused to the business and cost incurred to maintain the reputation and the client confidence. Some of these costs may be covered under the BI section, but may exclude the cost of, for example, strategy being put in place and people being involved in that strategy to regain the client's confidence. And in the longer term, and it may be difficult to quantify just that against the traditional method of cyber BI calculation and cyber BI wording. Usually, what would be covered is the loss of incomes. There may be a section for other services which will assist in rejection the impact on the client's business and its brand, such as PR cost, for example. But we've had some discussions recently on particular cases where having to put together a strategy to reduce the BI is incurring more cost, how this is going to be looked at and is it fully covered. And you also have seen that some policies at the moment have actually got a specific reputational harm cover section. Our understanding is that this usually goes back to the BI calculation, so it doesn't really, it's not set out as a separate thing. But we will also have seen that there is some different type of calculation where you would have discussed before coverage is taken the expected revenues or a predetermined revenue drop allocation that will be considered as a reputational harm. And then you will look into comparing that compared to the earning growth for that year, for example. So there is a way of looking into predetermined allocation or an average. And how do you mitigate the impact? Well, I think it's a holistic view. It's not only responding after an attack, it's really being prepared for it. Monitoring regularly, having appropriate backup policy. Certainly for the big corporate, we've seen recently that instead of making a payment for a ransom demand, having a very good backup policy, or just saving their bacon effectively. It does take time, but it was the most efficient way of getting everything back to normal. Having good segmentation between the system, making sure that you haven't got any systems that is very old and not supporting any longer, that would be a cause for concern, and where the vulnerabilities would lie. Vetting your service providers and the supply chain is also very essential, continuing with appropriate staff training and just not a tick box exercise. And then when something happens, having a good crisis management, knowing who you can use as a vendor. There's been quite a few discussion as well with using vendors that the insured preferred rather than policy ones. Again, that's something to be discussed before an attack rather than at the time of an emergency. And just trying to think about any other alternatives, and Terri will discuss that as well. Is trying to get the business as normal doesn't mean that you have to have 100% of your system fully recovered. There's other ways to operate maybe that you need to consider to mitigate your loss, and the readiness to move to the cloud sometimes to mitigate that loss rather than trying to restore the systems that you have. So I'm now going to hand off to Terri, and she will take you through business interruption and how this works in a cyber context.
Thank you very much, Laetitia. I'm going to share my screen, so excuse me while we just cover over where we are. Ooh, am I sharing my screen? Show screen. No. Okay, let's have a excuse me, just while I custom slide. That's not quite what I had in. Oops. Present view. Yes. Right, I think I've got it the wrong way around, so hold on. Is that the correct way? You can see the browser. No, we'll swap presenter. Good, hopefully that's it. Excuse me. A little bit of technology. Thank you very much, Laetitia. Yes, I am going to concentrate on how business interruption interlocks with the cyber covers that we're now seeing. Just though to scare a few people, Allianz do a very good annual risk barometer, and for many, many years, the biggest risk that major corporate clients said they had was business interruption. It's been #1 for several years. However, last year, 2019, cyber incidents came to the fore. I think that shows both the number of cyber effects we are seeing, but also the value that's associated with them. So we have, if you like, a double whammy between business interruption and cyber. It's not a comfortable place for managers to be in, and Laetitia is quite right that it's all about being prepared and seeing whether you can manage those issues. So very, very briefly, just business interruption. It's a traditional policy cover. It's been around about 150 years. However, it's now being applied to cyber incidents. So the trigger that sets off a business interruption claim can be a cyber incident. Typically, in the UK, we'll use the gross revenue less savings traditional approach, top down. But the American and continental version, which is net revenue and any continuing expenses, is also quite common in cyber policies. So as ever, RTP, read the policy. Business interruption will always have some kind of waiting period. It's a sort of self-imposed excess. Can be just a number of hours. It may be further and longer than that, but it's an element of self-insured retention. Sometimes, however, insurers will allow it as a franchise, i.e. you wait for a certain number of hours and then all the loss over those hours counts. But more commonly, it is a form of deductible. And then we have the interruption period. How long does the cover last for? In some cases, it can just be while the system is repaired or the incident is recovered or the systems are replaced. But more usually, we have a period of recovery following that because businesses don't immediately recover once they have had their incident handled. Quantification in the in the UK, we'll start with gross revenue. We'll look at the sales losses, apply the rate of gross profit that comes from their accounts, and then look at increased cost of working. And do be very careful at the definition. It's not everything that everybody thinks it is. And then there's less savings, any savings that arise as a direct result of the impact that we're looking at. In the US continental version, net revenue, we start at the bottom of the finance page and work up. The big question is, will it end up at the same figure? We would obviously hope that indemnity is the same either way. So for a small suggestion, I've worked two numbers, or one claim in the two formats. So this is the UK wording. We're looking at a shortfall in the expected sales. That would be 130. Whether it's dollars, pounds, doesn't matter, or thousands or millions, doesn't matter. But the shortfall in sales is 130. They made 70 pounds worth of sales against an expected 200. The rate of gross profit, 70%, remains the same because that is direct costs that are being reduced. So we have a shortfall of loss of gross profit, 91. However, if we look at their general expenses, they ended up spending more on staff, 10, but less on sales and office admin and less on property costs, perhaps utilities, perhaps other aspects. So the net effect of those two is a saving of 5, and we end up with a net claim of 86. So that's the idea. You know, if you look at their very bottom line, they expected to make a modest gross profit of 4, but in the month of our incident, they made a whacking great big loss of 82. And if we compensate them with 86, they end up back at where they should be. Oh, excuse me. This is the second version, starting with net profit. We end up with the same figure, 86. The shortfall between the two is 86. They expected to make net profit. They had continuing costs of finance and other general overheads, but they also did make some contribution from sales. So their net impact on profit is 86. So in this particular instance, thank goodness it does match. But you do need a forensic accountant very often to work out what you're doing with those figures when you get them from your claimant. Issues in quantification. So working out what the sales might have been is often the very biggest problem. We have to look at trends. We need to look at divisional effects, I should have said. Does it affect only online sales and their main retail outlets are unaffected, or does it affect every single thing? But more importantly, is there any kind of clawback? So once they have recovered, is there a time in which their customers have agreed to defer their sales orders to the later point? Are they able to go back into production and boost their production such that they can deliver more sales than they would normally? And overall, what is their net profit position? So have we looked at all the other factors that are affecting it? I do like to eliminate things like finance from net profit because that really has very little direct relationship to their sales volumes and obviously can quite often go out of kilter when they have a cyber impact. So we're looking also for the silent savings. Net profit will pick these up more easily, but we should always be looking for that. Issues with trends are further complicated at the moment with the unpredictability of the business world. We've obviously got COVID complications. Just some industries are benefiting and others are not. There's the overlay of enforced government lockdown, the closures that we're seeing in many countries. This can drive business online and therefore make the sales they might have expected online to be much higher than they would have otherwise been doing last year. We've come across issues where there is staff illness affecting productivity. Obviously, if they don't have as many people on the production line, they may not be able to produce as many items. And other sales channels, i.e. your retail high street, might not be affected if they're already locked down by the government. We also need to look at separating out costs which are insured elsewhere in the policy. It's very easy to have a big pot of extra costs, but they don't all fall into the business interruption. A business interruption increased cost of working should only be if it has a direct effect on the sales that are being made, i.e. does it buy more sales? So we have obviously the IT staff may be working overtime on restoration. Marketing or reputation protection costs, those are often specifically designated in the policy, and certainly they are more about reputation than specific sales. We've got the media and PR costs that they may incur as a result of an incident. Finance changes are always happening, And just to be warned, net profit is certainly not a steady figure. It would be nice if it was a flat for every month, but I think you'll find most businesses don't manage that. Just a quick demonstration of clawback or recovery. Obviously, if they expect the flat line, the 500 per week, after an incident, they may well still manage to get some sales out of the door. May not be perfect, but they may get some. Maybe it's out of stock, lasts for a couple of weeks at a very much reduced rate, then they are restored and recovered. But in both of these instances, there is a period of clawback or recovery where they are making more sales than they might otherwise have expected to do. And provided our interruption period lasts for those 7 weeks, all of that clawback will be handled within the claim period. Obviously, it's worth recognizing that in order to get that clawback, a business may well incur extra increased costs of working. Obviously, as long as they're economic, they are certainly worth doing because the business wants to secure their customers as much as possible. However, the clawback can also just be a bounce. It's incredible, but in this industry, we know that there is no such thing as bad news. Every item of news will have some kind of benefit because it at least brings you to the attention of others. Certainly, if you handle a cyber event properly, it can be beneficial to your overall reputation. Interruption period. I want to briefly just think about the interruption period. It obviously starts with the cyber trigger. It cannot start at any other date. It's not the date that the first intrusion happens, but the date of the actual impact or the discovery. Very often the interruption period will recognize a period of repairs and then also recognize a recovery period. So watch for that. With cyber policies, the interruption period is relatively short, perhaps 90 or 120 days. But do read the policy carefully for when the start date of that period is, because it can vary. And obviously we have a waiting period to deduct in the first place. Very important, the cut-off dates, because obviously it can affect both the sales losses and sales clawback, and also the effectiveness of increased costs. If increased costs are incurred, they are only acceptable in the policy if the sales to which they are influencing are within that interruption period. Very, very important. So we've got different wordings here. The waiting period, how long do you wait, 6 or 10 hours? It'll certainly be a specified time. Then we've got the interruption period beyond that. How long does it last and what's the date that's appropriate? So what we should be concerned about, we're looking at the start point, we're looking at the end point, and we're looking at the other factors that might come and hit a business within this period. We have obviously lockdowns changing all the time, so there are various dates that may incur at the same time where we have to identify a different sales trend to take into account. I'm going to look at a Black Friday outage shortly. Second point, are there any aggravating factors? Is there something that makes this even worse than it looks on paper? Is it that they can only sell certain products online, therefore it's not available while they're shut down? What sort of savings do we have to look into? And the mitigation that they're looking at, are those increased costs of working, or are there other areas of expense where it should be better gone? So it's a complex web of items that we're looking at. I want to look at a sample of increased costs of working. We have obviously very many WannaCry claims back to 2017 and around then. It was a very successful hack and lots and lots of claimants. We had a claim which was significant, 6 million, then rising to 9 million. But the issue was, what were all these costs? What were these costs? Were they to do with remediating the system? Were they to do with improving it? And obviously those costs often get slightly hidden in there. There was some prevention to look for. At the same time, we had the NotPetya situation. So while their IT was being restored, they were also upgrading it. Lots of hardware issues, but we had a significant level of costs incurred for staff time. Some of it was paid as overtime in the normal manner. Others were for people who went beyond their normal level, and the business was looking to compensate them either by way of a bonus or by way of time off in lieu. So we had to seriously look at all the details to look at them, and we went and visited one specific business unit and then took that as a sample across the whole business. One issue about management overtime or management bonuses, if they're not usually given any kind of overtime, it can be appropriate to consider an overtime recognition by way of a round sum amount. It shouldn't be hourly or anything like that, but it should also reflect the differing various levels of contribution. With toil, time off in lieu, I'm very reluctant to make a financial settlement because they will take that day off at a time to suit them and the business, and it very often doesn't mean that the business has any extra cost. They won't take on any temporary staff to manage that shortage. It's just like an extra day of holiday. So usually no financial cost from toil. Looking briefly at sales, we've got sales which can vary very significantly when they're online between the time of day and also the day in the week when they take place. So we've got an example here of hourly revenues for a business, which is obviously mostly active during daytime hours, between 9, well, certainly between 9 and 6 is their most active times, but certainly also continuing through to the evening with slight breaks for people's lunch and supper. So it was important, therefore, when we had a claim to reflect what were the days that were affected and what was the likely income that they could have normally expected to receive. So we've got the calculation down at the bottom showing how we looked at various different options, taking their own data for hourly sales and the specific timing of this outage. We also took out a period when they were, took out the waiting period, and we also took out a period when they were upgrading the system, as that was not covered. And we ended up with a settlement based on their own data, but specific to the days that were relevant to the claim. This is the Black Friday discussion that I mentioned earlier. So the website was shut down. A large Danish retailer with majority of their operations online, but also 20 retail outlets. They had a major incident which occurred on Black Friday, which meant they had to shut down their website. And obviously, as you'll know, Black Friday is by far and away biggest online. It is a US phenomenon, but it is very much here to stay now, the day after Thanksgiving, American Thanksgiving. So customers were at risk because of their credit data. The whole of the site had to be shut down, and a further attempt had to be made later in January to try and clean it all up, because there were various issues that they couldn't resolve. Once we looked at the data, it was clear that the online sales were zero, and it was very little. There was very little opportunity for them to move their sales to the shops, although they did attempt. So it was very much specific to the situation. But when we looked at the actual calculations, sorry, I'll go back and just show you that their gross profit claim was around 1.5 million Danish kroner. They really had a significant impact on their business. But when we started to look at the details of the claim, they had a growth factor of 41%, and that was reflecting online activities between 2017 and 2018. Some of that may still have been relevant, but we wanted to be a little bit more astute about the actual specific period we were looking at. And so in our analysis, we looked at 4 different alternatives, the bases are all there, and came up with a settlement suggestion which reduced the gross profit from about 1.5 to just over 1 million after savings, various overhead and other costs, particularly distribution, because online is very obviously a distributed sale. The loss went down to about 770,000. So we've got a good period, a good attribute in terms of that businesses now have data, and we should be looking at their data to drill into the figures and understand exactly how is it affecting us. So we have to consider the attack. Will it affect online sales only? Will it affect production? Review the costs, particularly in terms of mitigation. It's not a carte blanche to vendors to come in and trawl through all the opportunities, or indeed to everybody to just go on a spending spree. But we do have to consider both aggravating and mitigating factors and trends as we go through the loss. I do want to mention contingent BI. Contingent has been around for a long time. It's a risk that is outside the immediate asset dependency of the business. Traditional business interruption was all to do with the material damage proviso. Was there damage to existing property at the premises belonging to that business? And that was used for the purposes of the business. And in the absence of that asset, the business would experience losses. So did the loss flow directly from that asset? For many years, businesses have become more complex. They are no longer self-dependent. They are part of an integrated supply chain. They are very dependent on major customers. There are a whole level of interaction beyond their own immediate premises. So contingent BI has been developing quite strongly for many years. It recognizes key dependencies. It may be a manufacturer of a specific item that they use, or supplier of specific unusual materials that are not easily sourced anywhere else, or alternatively, something like a business that prepares frozen food for Marks and Spencers. Their key customer is therefore Marks and Spencers. The bulk of their products will be branded with Marks and Spencers. So there's a high dependency there. We also have other dependencies that might arise, things like dependency on utilities and basics for the business. So it covers the losses and loss of business and extra expenses that might arise from an interruption at a different location, not their own. Typically, the same peril that you have on your own business premises will apply at those contingent locations. So you might be covered for flood at your own premises, and therefore you'd be covered for flood at a supplier of your products. It doesn't necessarily mean you're covered for everything. Often there are sublimits which protect the underwriters. What we're moving on to, though, now is contingent BI in cyber policies. Obviously, we have a very much wider dependency range here. We have supply routes, supply channels, Amazon, Etsy, all of those items. We have payments through other online financial operations, such as PayPal or even your bank. There are brokerage operations where people only have online presences but are buying and selling online. Does the insurance match the risk? It is certainly an issue for underwriters here because it's a much wider exposure. So many people are looking for cover for contingent BI in cyber policies, and this can also extend to the reputational damage. So specifics of cyber claims. We've got expenditure on many areas, not only the business interruption, increased costs of working. We have issues with normal staff hours and salary exclusions. What to do when you have furlough staff. That is a big issue here because they are basically being paid by the government. It is not a cost that the business is experiencing themselves. BI can hit up against policy limits if there's a major claim against all the other aspects as well. What are the incident specifics? The recreation and restoration of data using internal staff rather than external. How does this actual cost reflect as an additional cost to the business, even though the external cost would of course be very large? We need to look at the timeline and the starting point, and catch up and multiple events. We've talked about Denmark with their multiple closures to handle the repairs. And then mitigations. Can we find some specific measures? Is there any sublimit? And again, sales in different areas. So the adjuster's challenges, that's mine really. Looking for the evidence, trying to find out the various business factors and the trends before and after the event. Certainly managing expectations, that's where particularly brokers can be helpful. Not all interruptions result in a business interruption claim. We have seen most recently, Laetitia and I, a claim which largely survived through sales of stock. They had a big stock holding, and although they weren't able to make any of the specific product, they had plenty of stock and were able to survive. And any sales loss will have fallen outside the indemnity period. That is an issue. Claims presentation. just really want to mention that many policies include a claims presentation clause, can be very useful, but the obligation then is on the presenter, usually the broker, to actually do a good job, interpret the policy and produce appropriate documentation to support the claim. It isn't good enough to just write a single figure down and send it in. It does require that claims presentation clause to be activated and used. We need to obtain evidence, including the right financial records to support the claim, and that can include evidence concerning stock utilization, timing, customer breakdowns. We saw that issue about the timing of the transactions online, all of those things. Particularly with employees, we may have issues with GDPR, but we're very happy to accept redacted pay slips and then a total at the bottom. There are certainly ways around it, and it does need to have some issues. And are there other issues? I am just rapidly going to finish off so that we can have some questions. So in summary, the cyber insurance market is developing. There's more BI cover available in the market, and that is leading to more BI claims. COVID impact on triggers and financial losses. We're not sure if this is the tip of the iceberg, but we are certainly seeing cyber increase. And also managing expectations in the course of a claim is really crucial. Thank you for your time. So, have we got any questions?
We have a question here.
Oh, good.
I'm just going to unmute them so that they can ask their question. Oh, they've put their hand back down.
Put them in on the chat line. We can see them. I think it's fair to say that Laetitia is involving me quite frequently on claims now. Cyber nearly always has a BI impact, as does any impact on a business. But it's certainly a driving force with the speed and reliance on internet and other communications. Businesses are highly dependent. So it does have an impact.
So we have a question here. Do you have any experience where you've both seen how a really good technical response has reduced the cyber BI? Can you tell us about it?
I suppose it's hard to see when it worked. We do know that it works. When we're dealing with somebody with strong technical knowledge and capabilities, they get on and handle it quickly, don't they, Laetitia?
Yeah, I think the main issue is having a good strategy beforehand, because then when you trigger it, if it's been tested before, you're not surprised. So having good practices in terms of backups, being able to have a remote backup that is recent enough to be able to put that back on. And if you've got segregated or segmented systems, then you're less likely to have a big impact. So having all of this beforehand should reduce your business interruption. We've had some very good stories recently where, the recovery was exceptionally very quick, but they had a very good backup policy. On the other hand, you will see that, it's not because you're an IT company or you're offering software services, for example, that you will be the best at that. So we're seeing different sectors responding differently, and some are very good, and some, I've got to say, they're surprisingly not that great. So it's all in the preparation beforehand.
Okay, another one here. Are you seeing any trends of industry types in terms of cyber lead, BI, NI matters?
We are seeing issues with waves. There's waves of attacks at the moment. We were discussing earlier that attackers are very opportunistic. So once they have something that works, they've tested, it works really well against a particular industry, they will try and deploy it on everyone they can. We've certainly seen that end of August for the educational services. They were hitting universities a lot, with various means. And universities have not only the data of the students, their staff, but they also do a lot of research. So it was a question of, are these universities involved in any kind of COVID-related research? Is that why they're hitting them? Are they involved in any other, cross-border research, and they're hitting them because they're maybe collaborating with someone in another country that they want to hit? It's difficult to see sometimes. We certainly have had some cases where we ask a lot of questions in terms of the motives behind it. But, the industries that have been the most impacted recently have been in different locations, because we deal with this globally, but manufacturing, certainly, professional services, financial services, definitely. Actually, the insurance industry is not immune either. We've seen quite a few cases recently as well. And generally, the IT sector, unfortunately, have been hit. And when they hit, actually, it just trickles down to some of their clients as well. So we talk about, BI, contingency, contingent BI, but also, being liable for some of your clients' losses, because you're the one that's providing that service to them. And if you're impacted, you impact all your clients effectively for the time you are down.
Okay, another one. What policy levers are likely to reduce BI exposures for insurers? Longer waiting periods, higher monetary deductibles, shorter or longer BI indemnity periods?
Okay, I might pick that up. I think the one that will restrict insurers' exposure is limiting their interruption period. The longer it goes on, the more the larger the loss will be. Now, obviously, many cyber incidents may be relatively short and may be sorted out within the 30-day, 60-day, whatever their indemnity period, but others could have a lasting impact, particularly those where they affect their market position and they can't recover that within such a short period of time. If they've built up a dominant position, say in online retail of some sort, but they have a cyber incident, they fail their customers will go elsewhere. And customers are creatures of habit. So if they've had a good service from a competitor online, they will continue to go there. And that sort of impact can last quite a long time. So I would say obviously monetary limits will help keep it down, but I believe it's the indemnity period that would really restrict it. Waiting periods are quite tricky to work out, but really we're only looking at the first half trading day or something, so they're not the biggest impact. But also I think for underwriters the biggest risk is contingent BI. How far does it go? How far does it stretch? When they're looking at your own systems, the client's own systems, you're restricting your exposure there because you know their business. Any other comments? I mean, it's a new and developing area, and certainly insurers are treading cautiously because BI can very often outweigh any other costs once the customer impact starts to hit.
For you, Terri, on slide 28, can you clarify your meaning of furlough?
Oh, furlough. I'm talking about the UK government approach to staff who have been sent home, not able to work, they're not permitted to work, and the government is paying up to 80% of their salary. So they are no longer an employee. In my view, they have come off the payroll, and there can be no savings related to them because the savings are all there anyway. They're not being paid, they can't work. So it's to do with the current COVID situation and reflecting the fact that what payroll they may have had a year ago could be very different in these COVID times. Does that help?
Yeah, that's great. So there's no more questions. So I guess we can leave it there. Any other comments that you may have, you can always send them in after. Oh, we have one here. A question on period of indemnity. Have you ever seen the deferred clawback cost sit outside the period of indemnity?
Yeah, not uncommon. Either the clawback of sale, obviously it can win both ways. Either the sales that are being clawed back are not clawed back completely quickly enough, and so insurers don't get the benefit of those. They're only looking at a very fixed term. But more commonly, what we see is the increased costs are committed to try and build up production and recover those sales, but because those are affecting the sales outside the indemnity period, effectively you end up with a sort of sharing between insurers' interests and the insured's interests. You know, they've spent a certain amount of money. Some of the sales are, if you like, for insurers' benefit within the indemnity period, and some of the sales are outside, and therefore you'll get an allocation of those costs. So it can work both ways, and it's particularly difficult to manage because you don't have very much time with a cyber claim. Everything is in real time, very fast. Decisions have to be made about mitigation, and it's not always clear when the sales benefit will actually come through. But it's still worth doing. I think even for the business, they would say it's worth mitigating a sale. They're only reducing their profit rather than losing it all. So it can still be very valuable. Very
Great.
good. No
So
more
that's it.
questions? Good.
Yeah.
Okay. Please send your feedback. That's very good. Thank you very much.
Thanks,
The
everyone.
slides will be available, yeah?
Yeah, we are going to send the recording, and we can send the slides as well for anyone who's interested.
Okay.
Perfect. Thank you very much,
Thank you very
everyone.
much.
Thank you. Bye-bye.